Good morning, everyone. Well, the G20 communique was much more receptive to the complaints of the emerging market countries than the draft that was circulating beforehand. It said that the monetary authorities of the developed countries should be, quote, mindful of impacts on the global economy, unquote, and that they would, quote, continue to cooperate on managing spillovers to other countries, unquote. These were clear concessions to the emerging market countries. They should win some friends in that at least it shows the developed economies acknowledge that their monetary policies have an impact on the EM countries. Whether it really does affect the conduct of monetary policy is another matter, however. The communique went on to say that the primary response of the G20 to policy transitions like this, quote, is to further strengthen and refine our domestic macroeconomic, structural, and financial policy frameworks. Exchange rate flexibility can also facilitate the adjustment of our economies, unquote. In other words, it's up to each individual country to get its house in order to deal with the changing world, and if currencies move, that's a necessary shock absorber in the system. This was the industrial nation's stance before the meeting. So, as usual, some talk, but no concrete actions, no concrete change. This morning, the dollar is mostly lower. It gained against the Australian dollar and New Zealand dollar as iron ore prices fell, but lost against all the other G10 currencies. This may reflect the possibility, however remote, that the Fed slows its tapering off of its bond purchases in response to the impact on EM countries, as we just heard. Personally, I doubt if anyone really thinks that that might happen, but at least the possibility is there, and dealers may be marking the dollar down on the basis that other dealers may be marking the dollar down in response to that possibility. That's the way the market works. The euro gained against the dollar, but was weaker on the crosses after ECB President Draghi repeated his willingness to act if deflation starts to take hold in Europe. And the yen rallied as almost all Asian stock markets fell. The main events on the agenda today are the German IFO survey for February and Eurozone final CPI for January. The IFO current assessment index is expected to be up, while the expectations index is forecast to be lower. Last month, both indices were higher than expected, but the euro didn't respond anyway. A similar reaction this time would indicate that the market's attention is focused on the Eurozone CPI data, which comes out an hour later. That figure will set the stage for the ECB's policy at its March 6th meeting next. Also on Thursday, we have Germany's preliminary CPI for February, followed by the preliminary Eurozone CPI for February on Friday. In the U.S., we've got the Chicago Fed National Activity Index and the Dallas Fed Manufacturing Index survey, the Dallas Fed Manufacturing Survey for February, the other one's for January coming out. Finally, former Fed Reserve Chairman Alan Greenspan speaks at a conference, and I'm sure we'll hear more self-justification from the maestro. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.